If you look at raw, tick-by-tick financial data, you won't see a strategy. You will just see chaos. This continuous stream of price action is essentially unfiltered noise. Without a structural framework to organize these micro-fluctuations, extracting a meaningful statistical edge is impossible. To make sense of this, we impose an artificial constraint. We take this erratic line and slice it vertically into equal intervals of time. By collapsing the movement within one isolated interval, we compress the noise into a structured geometric proxy, the candlestick. Extracting value from this geometry depends on your ability to synthesize it with external market variables. You need a rigorous, multi-factor conditional framework to separate actionable market signals from baseline volatility. The candlestick functions as a vector of market control, only becoming legible when integrated into a broader macro logic. This is a single candlestick. It records 4 exact data points for any session: open, high, low, and close. Operationally, these form 2 distinct records. The first is the central body, the solid space between the open and the close. This body records net directional conviction, providing visual proof of which side maintained control. The second record is the wick, representing the extremes of the session. These shadows are exact footprints of price rejection. When you see a long wick, you are looking at liquidity absorption. It shows the exact price level where aggressive market participants pushed the market out, only to be completely overwhelmed by passive limit orders that forced the price back. Understanding this internal anatomy turns a simple 2-dimensional shape into a readable map of intra-session order flow. Traders often look for specific morphologies, like an engulfing shape or a hammer, to signal dominance or rejection. The challenge is that on lower time frames, these micro-patterns often appear fractured and contradictory. A setup that looks valid on a 15-minute chart is often statistical noise. We resolve this through temporal aggregation. Timeframes are arbitrary data slices, which means they can be mathematically recombined to reveal true market structure. This equation shows how this works in practice, combining 2 distinct 1-hour candles, a bearish candle followed by a bullish engulfing candle. To build the composite 2-hour candle, we extract the initial opening price of the first hour and bridge it to the final closing price of the second hour. This forms the new central body. Next, we identify the absolute highest point reached across both hours to define the composite upper wick. Then we find the absolute lowest point between the 2 sessions to generate the extended lower wick. The mathematical result is clear. 2 conflicting 1-hour candles perfectly collapse into a single 2-hour rejection pin bar. This fractal aggregation naturally filters out the indecision and micro-volatility that plagues shorter intervals. Analyzing higher timeframes acts as a mathematical smoothing function, exposing the structural narratives hidden within lower frequency noise. A specific candle color or shape provides no inherent guarantee of future market direction. This chart demonstrates the isolation fallacy. If you buy every green bullish candle you see, you will routinely execute right into steep, cascading price drops. Isolated patterns fail because they completely lack structural market context. A green body showing upward conviction is statistically meaningless if the broader macro environment is heavily skewed toward dominant selling pressure. To prevent this, morphological patterns must be gated behind a rigid, non-negotiable conditional framework. Spotting a pattern is not a strategy. A valid quantitative strategy is defined by knowing exactly when to ignore the pattern. This schematic outlines the TAE execution model, which functions as a strict Boolean logic gate. All 3 sequential conditions, trend, area of value, and entry trigger, must evaluate to true to execute a trade. Condition 1 is the trend. A macro directional bias must be established first to dictate whether you are permitted to go long or short. This chart uses the 200-period simple moving average as that binary filter. Price action above the line restricts you to a long bias only, and action below restricts you to a short bias only. Condition 2 is the area of value. You need a localized spatial advantage before considering an entry. These boundaries manifest as structural support and resistance zones, where prior price action dictates that limit orders are stacked to defend a level. Condition 3 is the entry trigger. Here, the candlestick morphology is strictly utilized as a final timing mechanism. The operational rule is absolute. An entry trigger is mathematically invalid unless conditions 1 and 2 are completely satisfied. Let's step through a practical execution sequence to demonstrate the alignment of these three logic gates. First, an established macro downtrend fulfills condition 1. Next, the price approaches a prior support turned resistance ceiling, fulfilling condition 2. Finally, a tweezer top double rejection forms exactly at this ceiling, satisfying condition 3. By demanding this exact rigorous alignment, the TIE framework replaces emotional guessing with a high-probability algorithmic execution process. Technical analysis succeeds when you stop hunting for predictive patterns and begin processing data through strict conditional logic. This split-screen chart contrasts the two approaches. On the left, raw candlesticks generate endless conflicting microsignals. On the right, the TIE logic gates filter out the noise, isolating only the specific node where trend, value, and trigger align perfectly. Successful technical analysis is a rigorous process of elimination, not addition. The vast majority of continuous market action is simply noise designed to be systematically ignored. Execution comes down to respecting the open high-low close vector, utilizing temporal aggregation for clarity, and applying strict structural boundaries. By abandoning the isolation fallacy and enforcing these logic filters, analysts can consistently extract an asymmetric mathematical edge out of continuous market chaos.